Most people on the internet will tell you a million different ways to make money from stocks, but they're all wrong. Too much luck. Too risky. Just right? Value investing is one of the oldest ways people have been investing in stocks. Countless billionaires have used it, from Ben Graham to Michael Burry. Yet, most still fail at it, and many don't use it. Think of it like this. If you had the choice between an old analog camera and a phone, which would you use to take a picture? Odds are, probably the phone. But in reality, the camera is better. It's built like a tank, has manual aperture and focus, and is all around better for taking a picture, but most still choose the phone and end up getting a worse picture. The truth is, most still fail using value investing because they don't know these simple tricks to pick the best companies, all of which I'm going to go over in this video. The first important pillar of value investing is changing your mindset. But why? Oftentimes, investors get so fixated on numbers that they forget what a stock even is. In essence, purchasing a stock is buying a tiny piece of a real-world company. Therefore, for someone to excel at value investing, they need to change how they think. And instead of asking themselves, is this stock great? They should ask, is the company behind this stock great? Using this logic, it's more important to see if the company has a recognizable brand, needs little cash to operate, has low debt, and will still be needed in 20 years compared to poring over candlestick graphs and obscure technical indicators that even most professional investors can't correctly explain. There's still one important step, however, and if you don't do it, you've still not truly shifted your mindset enough. This trick is one that billionaire investor Warren Buffett used throughout his whole career. Instead of looking at the price of his stocks on a given day, Buffett actually ignored it and only looked at company news, sales, and management changes. But why? The truth is, looking at the price of a stock is like a farmer checking the value of his land every hour. It does nothing to help the corn grow, but it certainly keeps the farmer from sleeping. When you ignore the price and focus on the news, the quarterly earnings, the management decisions, the competitive landscape, you are checking the health of the soil. The farmer who focuses on the crops will eventually be wealthy. The farmer who focuses on the land appraisal sign in his yard will eventually be exhausted. By shifting your focus from the price, what someone else thinks it's worth, to the value, what the company is actually doing, you gain the superpower of patience. In the words of Buffett, the stock market is a device for transferring money from the impatient to the patient. Did you know that there's a guaranteed mathematical formula to find the fair valuation of a stock? But why do you need it for value investing? Oftentimes, people fail at value investing because they find an amazing company, so they buy, but they ignore a massive problem. The company is monstrously overvalued. Take Apple. Apple is a fantastic company. They have massive services revenue, a world-renowned brand, and in 20 years, people will still be buying iPhones, MacBooks, and Apple TV subscriptions. So why aren't they a good stock to invest in? The truth is, Apple would be a horrible investment for a value investor right now, as their share price is well above their true valuation. Before going into how to calculate fair value, we first need to understand what fair value means. A company's fair value is the principle that a company is worth the sum of all the cash it will generate in the future, brought back to today's value. So how do we calculate it? First, you have to play the role of a fortune teller, but with a calculator. You estimate how much free cash flow the company will generate each year for the next 5 to 10 years. So how would that look for Apple? For a company like Apple, you're looking at hardware sales and service subscriptions, their biggest revenue drivers. Next, we need to account for inflation. But why? Because of inflation and the fact that a dollar today is worth more than a dollar 10 years from now, we have to discount those future earnings back to the present. We use the discount rate, also known as E. Think of this as your hurdle rate. If you assume a 10% return, you use that to shrink those future billions down to what they are worth in today's pocket. The final step is to look at the future of the company. We assume a powerhouse like Apple won't just disappear after 10 years, so we calculate the terminal value, or TV. This represents the value of all the cash the company will ever make from year 11, usually based on a modest, permanent growth rate that accounts for pessimistic circumstances. Applying all these principles to Apple, we can see that, unlike their current valuation of $260, a fairer share price for them is $200 to $5, much lower than their current valuation. If you had to pick between Oreos and Hydrox, which would you choose? The truth is almost always the Oreos, but not for the reason you might think. What is the biggest difference between these two products? Brand. Brand is the glue that keeps customers coming back for more. Without a brand, you would use a product, and even if it was good, you would move on to something else just as available. So what does the brand change? With a recognizable brand, you will always buy from that company and only that company. Even if a box of Cheerios is more expensive than a box of generic cereal, most still buy the Cheerios. A brand is so powerful that even if a superior product exists, If the other has a stronger brand, most will go for it instead. Here's an example. Most don't know this secret about Oreo, but in fact, Oreo is the ripoff, not Hydrox. Hydrox was invented a full 4 years before Oreo, and Oreo was a direct ripoff. But with the power of brand, no one today knows or cares that Oreos are the true ripoff product, despite some insisting that Hydrox cookies are a better product. Brand has even become such a recognized tool in a company that just the name of a company can sell for billions of dollars. Take Polaroid. The original Polaroid company went bankrupt years ago. The Polaroid brand you see today on TVs or instant cameras is owned by a completely different group of investors who bought the name because people still trust it, showing the true value of the brand. So, why is brand so important for value investing? Firstly, a brand keeps companies safe from competitors.
You're the punk I've heard about.
Despite new competition entering the market and offering cheaper products, the one with a stronger brand can keep their prices high, and therefore their revenue as well, knowing that most of their consumers won't leave them as they have built trust and loyalty.
When I'll do anything, I'll do whatever it takes to...
In addition, new competition is quite low, as most know that it is nearly impossible to steal consumers from a well-established brand, and therefore don't bother. Secondly, well-established brands have pricing power. But what is pricing power? When the cost of raw inputs such as lumber, energy, or labor increases, well-established brands can pass the cost on to consumers, knowing they will still buy, whereas generic brands can't, as competitive price is their only competitive advantage. Finally, a well-established brand often signals stability, as well-established brands have more predictable future revenue, which is useful for previously mentioned intrinsic value calculations. The final part of value investment is one that seems dumb but is ignored by almost everyone. So what is it? If we look at investor Warren Buffett's stock picks over the last decades, there is one thing that they all have in common, despite being completely different companies. Simplicity. Look at See's Candies. On paper, they are a remarkably simple business to understand. What do they sell? Candy. Now look at a company like Nvidia. Despite Nvidia's strong stock growth, the truth is they are a remarkably complex business. To better understand this, let's go back in time. In the beginning of the 2000s, Nvidia was a relatively simple company, as most of their revenue came from a predictable source: gaming. Gaming was a relatively simple niche for Nvidia. They sold graphics cards and kept innovating with the invention of CUDA and other gaming-adjacent products. However, in 2022, everything changed. In late 2022, ChatGPT was released to the public. As the demand for NVIDIA GPUs for AI have skyrocketed, so has NVIDIA's revenue concentration. As of today, data center sales represent over 90% of NVIDIA's current valuation. This makes for a remarkably murky company, where a single speck of dust could crater its revenue. If an alternate competitor emerges, AI return on investment is lower than expected, and the company would contract almost overnight. Now compare this to See's Candies. They sell one thing: candy. Candy is simple. It has been bought and sold for hundreds of years and will keep being eaten for hundreds more. It's stupidly simple. People like candy. They will keep liking candy, so they don't need to complexify. The mark of a truly amazing value investment is a company whose business model could be written in one sentence, like "they sell candy," and Warren Buffett's portfolio shows it. So if you use this 4-step plan when picking your stocks, you will find a great value investment. If you found this video helpful, make sure to subscribe and check out my other videos.